Well, welcome everybody to the November, our special Thanksgiving edition of the Roundtable. Again, for those of you that are new to this, we've been doing this for about 4.5 years, coming up on 5 now. And this is obviously our turkey edition. We're going to focus on eating more chicken, less turkey. Makes the turkeys a little bit less anxious about the holiday. But I'm joined here this morning by our dear friend from Evansville, Indiana, Kim Butcher. She's a stock picker who has served as an educator at many Better Investing national events and on a number of panels with all of us. And we welcome Kim to this month's session as one of our guest damsels. Also joined by Ken Kavula, again, national educator, participant in at least 19 different investment clubs. Actually 4, but pretty well versed on the stuff we're going to go over. Hugh McManus joins us this morning from Pasadena. He's not globe-trotting this morning, so he's able to make it. And my name is Mark Robertson, manager, partner, and founder of Manifest Investing. We're happy to help out the Michigan investors here with this program. So why don't you go ahead and slide us forward, Ken? We'll get the legalities out of the way. This session is intended to be a demonstration. It's about education. It's basically taking the stuff that we've learned over the past 70+ years in the modern investment club movement when it comes to the study of stocks. We'll delve into the philosophy and the process, the various methods that we use, but everything that we do here is for illustration only, and please do your own homework. No investment recommendation is ever intended. If you know somebody who would like to be added to the reminder list, down at the bottom there you can see Natalie Kavula's email address, nkavula1@comcast.net. And then if you have any questions, you can either post them in the Manifest forum if you're a Manifest Investing subscriber, or send them to that email address and we'd be happy to get back to you. So let's go ahead and get launched. Here's our standing agenda. Again, a big hearty welcome to those of you who may be new to this. Those of you that are back, welcome back. This is kind of our standing agenda. We'll go over a look at past results, talk about some bigger picture issues. I did not put together a challenge for the hot seat. We'll probably do more of that next month if it's needed. As you'll see, it probably isn't needed this month. Then we'll go into our stock selections: T. Rowe Price, Liberty Media, BP Amoco, and ITC Holdings. And then there will be an audience poll at the end. All right, just a reminder what we're trying to do here. We're bringing an idea this morning, an idea that happens to be near the top of all 4 of our hunt lists or shopping lists, that sort of thing. We're going to kick through our single favorite investment opportunity, at least one that's on the leaderboard. And we do keep track. We keep a tracking portfolio. We would like to see that tracking portfolio outperform the Wilshire 5000. That's our benchmark for the general stock market by 5 percentage points over the long term, and we think that's feasible. We'd settle for anything between 0 and 5, but we really would like to see us approach that 5 percentage point advantage over the long term, and we also like to see over half of our selections outperform the market. We compare every selection that we make versus a mirroring or a matching investment in the Wilshire 5000. So we do keep track of that. Here's a look at that scoreboard over time. You can see we surged ahead pretty well there in our 3rd year and kind of took a few months off. The trend is in the right direction. That red dotted line across the middle there at 5%, that really is kind of the standard of the investment club philosophy. We'd like to beat the market by 5 percentage points. That magic 15% number that you hear, we believe, can be interpreted to be a 5 percentage point advantage to the very long-term return on stocks, which is approximately 10%. So again, we're always trying to beat that long-term return on stocks. And again, if the long-term return is 10, beating it by 5% would mean that you would come in at 15. So you can see we've languished a little bit, but definitely headed in the right direction. And we've actually had some pretty good days here over the last year. And sometimes these ideas take a little bit of time. Down towards the bottom, you can see that our accuracy, again, we keep track of every single selection, every single decision made, whether it be made by a knight, damsel, or the audience. And right now we're running at about, that's about 3 out of 7 selections beating the market, but there's a whole bunch of them that are just barely in the red. So again, nothing to get too concerned about. Here's a look at the top 16 or 17 stocks in the tracking portfolio. At the very bottom of the page on the lower left, you can actually access the entire portfolio at any time. This is just the top end of it. These are the companies that would influence our overall results the most. And you can see them from top to bottom. They are ranked by the size of the position in the portfolio. And we did something for you a little bit special this month. The number in parentheses that you see after every single entry is the number of times they've been chosen. And again, that choice can be made by a knight, damsel, or the audience, any of the three. And the number of selections is shown. So at the very top of the chart, Cognizant Technology has been chosen 10 times by, I believe, Cy Lynch 8 times in the audience once, and I believe I may have chosen it once, but a total of 10 times. Every time it's chosen, we invest $1,000 into it. So that at the very top you see Cognizant at $10,000 is now worth that fifth column over $14,587.57 this weekend. So it's actually gone up quite a bit here in the last few months. And again, as Cy has picked it 8 times, that helps his overall results specifically. But as you kind of wander down the chart, you can see Apple in that second slot has been selected 6 times. So $6,000 has become $10,711.86. So anybody?
I just think it's really fascinating, Mark, that for our own investments in this portfolio here, it seems that Microsoft is actually doing as well, or maybe even a little bit better than Apple in the portfolio.
Yeah, we spent quite a bit of time talking about Microsoft in Seattle, not just because we were patronizing the home team, but one of the things that we have noticed in the last 2 to 3 years was quite an accumulation of Microsoft on our Manifest 40 most widely followed stocks, and it actually began shooting up, and that would imply some fairly serious accumulation over the last 18 months to 2 years, just in time for Microsoft to go from roughly 25 to somewhere between 40 and 50. So that's actually pretty cool. And as Ken points out, $5,000 invested in Microsoft is now $9,400. I believe most of those Microsoft selections belong to Hugh. So he's got to be smiling again. So just kind of down top to bottom, down at the very bottom, there's a legend which shows how many of the stocks that have been selected more than once. So you can keep track of that also. Any other questions or comments on this part of the tracking portfolio? So with that, I thought we'd, in the spirit of Thanksgiving, I think we need, and specifically me, need to give thanks for Apple, for one thing, over the last several months. Some of those selections were made under duress, and you'll notice that the audience, and yes, I'm talking to all of you, you didn't come with me. You had the opportunity to vote and come with me, but you didn't. It's actually done pretty well. What you're looking at here is a list of the relative return. Again, that's a comparison to what the market did over the same holding period. The entries that are highlighted are closed positions. So the original purchase date with an end date, if it doesn't have an end date, it's still open. It's still in the active tracking portfolio. So there's a lot to be thankful for on this slide. Every single person here today has a stock on the leaderboard. Kim is up at the all-time historical results with her selection of McGraw-Hill back in February 2013. Just looking down the list, I mean, Southwest Airlines. Hugh and I both selected that back over the last couple of years, and that performed very well for us. Other selections, like Ken pointed out, Portfolio Recovery has only been selected a couple of times, but has really kind of hit it out of the park for both Ken and guest damsel Ann Manning. So from top to bottom, and you can see Cognizant's kind of sneaking up the list there with Cy's June 2013 selection of Cognizant. So good stuff from top to bottom.
I wish I would have stalled out on Polaris for 5 or 6 months in a row, you know.
The Polaris one, it's really worthy of mention, and I'm not just saying this because, you know, I'm just not. I mean, if you go back and look at that April 2013 presentation, it's a great presentation, and obviously a very timely pick. Maximus has been good to us. Walgreen was good too. Look at the number of McManuses there under Walgreen, when some of us wondered if that one was going to work out. So good
Kim
stuff.
will let you keep coming back anytime you want to come back, as long as you pick them like McGraw-Hill.
Yep, good stuff.
No problem. I seem to find an affinity to spin-off stocks, and that was a spin-off stock.
She's going to cover that in some detail for us here today. All right, let's go ahead and talk a little bit about bigger picture. I thought I would just spend a moment. Ken and I spent some time with audiences in Dallas. We covered this a bit in Seattle. You know that we like to emphasize quality here at Manifest Investing and Better Investing. This happens to be a snapshot of Jeremy Grantham. He defines quality, I think, in very common sense, down-to-earth terms: dependability, delivering superior results over time. And the area that it really takes shape during our stock studies is when we're looking at the management report cards, the Section 2A and 2B analysis of essentially returns measured versus sales, or various ways that we measure profitability. But pretty good stuff. And what I thought we would do is just spend a moment, and anybody feel free to chime in here. Go ahead and fast forward here, Ken, to the next one. As many of you know, we've been looking at the book, Evaluation of Common Stocks, written by the founder of Value Line, Arnold Bernard. And this happens to be a list of stocks where he mentions a number of companies. By the way, he starts the book off with quality, discussing the concept of quality. And the companies on the left, I'll give you the nutshell version. All of those are alive and kicking and giving pretty good service to their shareholders. The ones on the right-hand side, list C, the more speculative stocks. Again, this list was written back in 1958, so that's how old it is. And most, if not all, of those companies are either gone or completely bankrupt in column C. And then down the middle you have mixed results. But I took that chart. Go ahead and click to the next slide, because I think you guys will get a big kick out of this one. This is going to be in our cover story this month. But actually going back to the oldest available dates for many of these companies back to 1962, and actually looking at their total returns, comparing versus the market returns. And as you can see here, pretty solid results from this group of, in most cases, stalwarts from top to bottom. The only company here that's in kind of triage right now is J.C. Penney, and their results are a little bit lackluster. But from top to bottom, some pretty serious, solid results. If you had invested $10,000 into these stocks back around that time frame, some 55 years ago, that $10,000 would be worth $707,000. I just find that magnificent on top of the quality. So again, when you think about sleep at night, I think there's a real powerful lesson here. If you took the 10 stocks in column C, that $10,000 would basically be worth zero today. I mean, think about that, 707,000 versus zero. So I just think that's fascinating, and kind of underscores why we care so much about finding leaders, best of the group, trying to discover them and discover buying opportunities when they're on sale. But again, over the long term, it really is the quality that matters to sleep at night investing.
Mark, I think what's also worthy of mention is that you only need a fairly small relative return for it to become statistically relevant. I mean, this relative return is 1.4% above the market, but I think that's statistically relevant as far as looking at companies that have the kind of quality that can deliver year over year over year. I know that we aim at 5%, but if you could do 1.5% to 2.5%, I think you're in rarefied atmosphere.
Yeah,
I think another thing that is very important about management is their quality of being capital allocators and how they grow their company. Because are they growing the company for the benefit of the shareholders, or are they growing the company for their ego? So how well they do with their return on invested capital is so important.
Very much so. And I mean, these companies have served their shareholders obviously quite well. And I think that leads into the next slide a little bit. This actually comes from Jeremy Grantham's firm, GMO. And you can actually sign up to receive this. I think it comes out monthly, if not quarterly, from GMO. If you go to gmo.com, what this points out is in the opinion, in the analysis of GMO, returns are a little bit lackluster on the left-hand side. They always have that the third one from the left, U.S. high quality. Many of the companies on that previous slide would be part of that. And what this is basically saying is, maybe they're a little bit more in the holds, perhaps even some in the sell zone right now. But again, the opportunities really, according to them, appear to be, and they're not strong opportunities, in the emerging markets right now. And it's kind of fun just to look back. You can go back and look at these charts over time, and they do basically kind of some of the same kind of stuff that we do. We put out our own version of this chart from time to time, but again, you can sign up for it. The other thing, it kind of ties into that interest rate question asked in the green room. If you go down to the bottom, you can actually track their assumption for, this is GMO's assumption for inflation. They project it to be 2.2% over the next 15 years or so. So they're not looking for a huge amount of inflation. All right, I think we're good with that. Ken, I think we're going to switch me to the leadoff position in case I need to run off to the airport. Just click through some of the slides and you'll have to come back. I don't get to lead off very often, so I'm going to go ahead and take advantage of this opportunity. What you see here is we often like to do is tell you where ideas come from or show you some screening results, that sort of thing. And what I'd like to show you here is I basically looked through the stocks that are both in the portfolio and outside the portfolio, looking for some of the better candidates for either repeating a selection. The top 6 would be repeat selections, and the bottom 6 would be companies from outside that aren't yet in the round table tracking portfolio. So I basically looked in both places. I mean, if I'm shopping this morning with real dollars, I would probably cross out a few of them. Not real wild about China, not yet. Just doesn't feel right to me this morning. I'd probably discount NetEase. Mindray Medical is also Chinese, so is New Oriental Education. And since I can't figure out Coach and Michael Kors and what in the world's going on in retail right now, might come back to that sometime very soon, but not this morning. I would also cross out Urban Outfitters, Coors, and Fossil right now. Facebook, I'm not real wild about Facebook, although my wife flaunts and taunts that one. She bought that on day one and has done pretty well with it. And I just come back to some of those up at the top then. Cognizant would be a very strong selection for me right now, but we've already selected it 10 times, and I think we'll let Cy Lynch go up or down with that ship. It is the second most widely followed company by our community. In fact, I think Ken discovered that 47 out of 48 model portfolios at model investment clubs across the country had Cognizant in their portfolios. So pretty well followed community stock. So that basically leaves us back up at the top of the list. Qualcomm and TROW price, I like them both. We're not reaching for the sky with our mid-teens return forecast. You can see the projected annual return there. Both of these have been selected for the roundtable portfolio. They're both very high quality companies. And I just kind of settle into TROW price, a company that we featured a couple of months ago, and we're actually featuring Qualcomm right now. So let's go ahead and do TROW price again. Go ahead and click me through to the next one. This is a high quality company. They provide asset management, basically a bunch of mutual funds and that kind of stuff. What you see here is a look at a number of key characteristics for the company. This is a mock-up of our company report page that we're putting together right now. We hope to bring these thumbnail graphs to you pretty soon. Every single company page will have these. But again, on the right-hand side, you can see the book value, the earnings per share are definitely not necessarily perfectly straight, but up in parallel. Profitability in the form of return on equity seems to be pretty steady. And again, PE ratio, they had the 1 year during the Great Recession that was a little bit unusually high because of low earnings, but the PE ratios have consistently clicked in the high teens, if not low 20s. So let's go ahead and take a look at them one by one, stopping at each major milestone. What you see here is a look at the book value over time. And again, for the companies in the financial sector that truly are asset-based, and by that I mean assets under management based, where they really make their profits by building this pile of assets or cash and then generating a return on that pile. It's literally no different than the way Warren Buffett looks at Berkshire Hathaway. He has this big pile of companies, it's a big pile of cash and cash flow, but he really does track the progress of Berkshire Hathaway by looking at the book value over time. Same thing is true here with T. Rowe Price. Their book value over time has been very steady, and we pay a great deal of attention to the growth of that book value over time. You can see the earnings have also been fairly steady on the lower half. So again, a fairly favorable picture. So let's go ahead and check in on the next one, with growth at, again, somewhere around 10, maybe 12% per year. The profitability measured by return on equity. Again, a valid thing to do if you're taking a look at book value, return on equity, which is basically book value. Pretty steady, with the exception of that 1 year in the depths of the Great Recession. These guys have a return on equity in the 20% range. And I would be very comfortable using a 20% value for return on equity. The price to earnings ratio over time, again, seems to be kind of settling in, perhaps relaxing a bit. This is an area where Value Line might be being a little uncharacteristically pessimistic about T. Rowe Price, but again, I could rationalize a PE anywhere between 15 to 20, maybe 15 to 18 based on this picture alone. Go ahead and click me through the next one, Ken. This is just a closer look at some of the key milestones and how they might stack up. The consensus, again, keep in mind that everything we do at Manifest Investing is a consensus effort based on what we see from Value Line, Morningstar, Standard & Poor's, the analyst consensus, that sort of thing. So that number that you see at the bottom is basically saying we have this company with a book value of $20.80. That's an interpolation at Value Line, growing at 12.5% with a return on equity of 21.3%. Basically leading us to a 5-year earnings per share forecast of about $8. If the PE, and again, that's a consensus PE based on inputs from Value Line, Morningstar, and S&P, is 19, you're basically looking at a return forecast of 15.3 at the very bottom, and that includes a projected dividend yield of about 2.5%. So again, we're talking about 15% type return. The company has been a little bit languishing, but operating results continue to be quite strong. If we were to inject our own input, for example, the book value coming from Finance Yahoo of closer to $20, trimming a little bit of growth, a little bit of return on equity, and trimming the average PE ratio down to 17.5, being a little more pessimistic, a lot like Value Line, we still see a price appreciation annualized of about 8%. And even with a dividend yield closer to 2 than 2.5, we're talking about a company that is still in low double digits, and I think very attractive in the field of opportunity out there today. So T. Rowe Price, very high quality company, and you'll get a chance to vote on that. And since I won't be around, somebody cast a vote on my behalf later on in the session. Thanks, Ken.
Thank you, Mark. Give me a moment here. I'm going to move to the beginning of Kim's slides. And I think, is this the first slide right here, Kim?
Yep.
Yep.
There we go.
Okay. Here's a little background. I have been going to the Berkshire Hathaway meeting for the last 3 years out of 4, and every year Buffett recommends a book to read, and this is the book, The Outsiders, that was recommended to read last year. So I got it this year when I went, and interesting enough, on chapter 4, It was called Value Creation in a Fast-Moving Stream, and it was about John Malone and TCI, which was a cable entity. He started off as an engineer, ultimately ended up being a CEO of a company, and as the question says, how do you make $500 million in less than 2 years? Start with $50 million, ask John Malone. He did it. He did it in the cable industry. So as you can see, ultimately he's a great manager of his funds. He abhors paying any kind of taxes. He's the one who developed the spin-off of stocks, because ultimately spin-offs are more tax efficient, because you own the stock and then it gets spun off to you. You don't have any taxes, so you don't have to pay any capital gains. So I found, as I read this book, I went looking to see if anything was, did he own any stock still, or has he retired, or what was going on. And he owned quite a bit of Liberty Media here, LMCA. And Liberty Media, and Cy should be here because he actually owns the Atlanta Braves. But the interesting thing is Liberty Media owns 52% of Sirius Radio, and all of us know about Sirius Radio. Well, they infused a whole bunch of cash into Sirius Radio, and if you looked at Sirius Radio just as an individual company, they have got some huge amount of cash flows. So actually Liberty Media is really a holding company, and they have other companies underneath it, kind of like how Buffett does with Berkshire Hathaway. And they take the excess cash from some of these companies to invest in other companies, buy back shares, spin off other companies. And they own also Charter Communications out of St. Louis. And actually, Charter Communications is like the #6 cable provider in the United States. Now, how many of you have got cable in your home? I think everybody's hands goes up. How many of you keep seeing the daggone bill go up? Same thing again. So for me, this was an idea that, maybe I can make some money on this. Next slide. So I also remembered that when I had read this book, The Stock Market Genius, the Stock Market Genius book is one of the books that someone had recommended to one of the banks that I went to, and it talks about and explains spin-offs. And spin-offs are real confusing, but the other thing that you can, it's really interesting, is there was a case study in the book about Liberty Media with telecommunications and how John Malone did it, and how he spun off the stock. And you know what, we just talked about quality of management. Well, if you've got quality of management and he can take $50 million and make $2 billion in 2 years and get a I'm not going to complain about that. Now, this is Wally Weitz. He's another guy that manages a portfolio in Omaha. It's the Weitz Investments Fund. And he has Liberty Media in his portfolio, and Charter Communications in this, the Sirius Radio, Live Nation. Now, the thing that was going to be interesting in all this is with Liberty Media having all this, I recognize that they have huge amounts of cash flow. And I'm somebody who likes cash flow, and actually John Malone was the one who decided that when some people talk about earnings per share growth, he always felt it was more important to talk about cash flow growth. So next slide. Liberty Media and the Value Fund and Wally Weitz, the Hickory Fund, the bottom line is Wally Weitz invests in, he follows Malone and invests in those pieces of what Malone spins off and does. So you can see where you've got the Live Nation, Liberty Interactive, Liberty Global, and he actually, when he sold off his TCI and made it into Liberty Media, then he sold that off. He actually went to Europe and he consolidated all of, he's starting to consolidate all the cable over in Europe, and that's that Liberty Global, that's that stock. So Liberty Media has 3 kinds of shares. Liberty A is 1 share, 1 vote. Liberty B is 1 share, 10 votes. Liberty C is 1 share, no votes. But if I was going to buy a stock and I wasn't going to vote on it at all, I don't think I'd really worry about if I can get that kind of return. So I was real excited to see that Wally White's, because I recognized he followed the stock. And if you can see, he's got some pretty good returns. He's also got all the stocks in there. Next slide. Now, this past Wednesday, Liberty Media had an Investors Day. Now, if you look at this, the value per share of Liberty Media has increased 8-fold. So that would be an 8-bagger since 2006. Now, obviously, that shows for great quality, as well as John Malone is not the CEO. He's one of the board of directors on Liberty Media now. Greg Mahaffey is, and he was from Microsoft. So these two have worked together. Greg Mahaffey has taught John Malone how he does what he does, and he does an excellent job, because in hating taxes, they used to have meetings once a week on how to avoid paying taxes. So if we can avoid paying taxes, that leaves more money in our back pocket, which I think is great, because what Buffett just did with Procter & Gamble, it says that, you know, they saved $1 billion by not having to sell the stock for that exchange and acquisition. They exchanged the stock back and forth, and that those capital gains they didn't have to pay. Now, Liberty Media doesn't have very much of a history here, so it's kind of hard to make a judgment by an SSG, but I think the biggest thing that I'm finding here is that with the quality of the management, and if you can have a 9-bagger from 2006 to 2014, that's not too shabby. So this would be everyone would, you know, make some more evaluations on your own, but with the excellent quality of the management that's at Liberty Media, this would be a stock I would consider. Now, the most interesting part is on November the 4th, Liberty Media spun off Liberty Broadband. And Liberty Broadband is another stock that we'll probably discuss next month at Manifest, and Greg Mahaffey and John Malone both are on the board of directors on this stock, and I'm not complaining too much, because I will be honest, I own Liberty Media in my portfolio, and with the spinoff I got Liberty Broadband, and Liberty Broadband's already up 10%. So that'll be another stock we'll consider. So thank you so much.
Kim, we have a question from Michelle. Michelle, you're unmuted. Go ahead.
Yes, Michelle.
Oh, no, you can disregard. I'm sorry.
Okay, and we have another question from Mary. Marianne, you're unmuted. Go ahead.
Hi, everybody. When I was looking, this wasn't on Kim's, this was on when Mark was going over stuff. One of the things that I noticed on slide 10 was that there were 2 stocks that relatively weren't as high out of 10. That fits better investing, saying 1 in 5 might not do what you expect, but the rest will do more than you expect.
Oh, the rule of 5. Well, thank you for pointing that out. We appreciate that. I also have, Kim, a question from Nancy, and she wants to know, are there any tax implications when you buy a holding company? Is it anything like a limited partnership, or shouldn't you worry about it?
No, because what happens is when I have Liberty Media, they spun off the Charter Communications, which was their cable division that they had underneath Liberty Media. So it's a tax-free spinoff. Now, if I decide to sell Liberty Broadband, which Charter Communications is under now, then I would have a tax obligation to pay for it. But with a spinoff, most times spinoffs are done to avoid any taxes.
Yeah, I think Nancy's question might be in a slightly different direction. Nancy, I think you're asking whether a holding company is an appropriate equity to put into a club's portfolio, and I don't think a holding company has any problems with holding it in a club's portfolio. In fact, I think you'll find that many financial companies are technically holding companies. The company that I'm going to present later on today is a holding company, and I don't think putting them in your portfolios cause any problems. I do know what you're talking about when you're talking about limited partnerships. They are taxed differently, and the money that comes back to the club or the individual is not truly a dividend. So I do understand your question, and I don't think holding companies have any issues in that regard. Any other questions for Kim? We'll try to get answered at the end of the session. And now we're going to move to Hugh. And Hugh, you're doing BP Amoco. And Hugh, I'm not hearing.
Hey,
there
everyone.
we go. Okay, great.
Yeah, you can hear me okay?
We can hear you just
Yeah,
fine. Go
I'm
ahead,
going
Hugh.
to look at, I'm going to look at BP. This is a chart that Mark has put in, but we'll move along to the next slide. And I'll go through what I do every week. If there's a number of companies that every month there's a number of companies that I look at, and I'm very keen to find companies that are close to 52-week low. If it's a large company, if it's a small company, I prefer to be closer to a multi-year low. But these are ordered, you can see by the fourth column from the left, where it says bottom. It's actually bottom of a rung of ladder starting from its low price in the last 52 weeks all the way up to its high price. So on the top of that list, there's a company Direct. We're not going to look at it, but it's within 13% of its low, which was 72 cents a share. It's a penny stock. All the way up to Staples, which is now at $14 and change, and it's within 60% of its 52-week low. So it's just a screen, at least, that I apply on a regular basis when I'm interested in buying things. Interestingly, Aflac, which is a company we all know and love, is getting close to a 52-week low, but who knows if it'll go there. On the next slide, I've added PAR in there as well, over in the far right-hand column, and then not surprisingly, companies that are near their 52-week low have a very high, relatively higher projected annual return. And for the case of BP, it's 12%. Qualcomm is a higher, it's 16%. Aflac is higher also at 13%, but BP is where I focused on, and you can see on the next slide. Just circle the ones, and I've selected BP for reasons I'll discuss as we move along. And then if we go to the other end of the list, which is on the next slide, these are companies that are close to their 52-week high. Apple now within 2.5% of its 52-week high, but these are all quality companies. And actually, with some notable exceptions, Apple being one of them, most of them have very low projected annual returns. We can see that on the next slide, where Apple and Google, I believe, Google has a high projected annual return of 15%, even though it's within 3 percentage points or thereabouts, 3.63 percentage points of its 52-week high. And some of them, including Yahoo and Sigma Aldrich, which is going to be acquired, have a negative projected annual return. Owners of Sigma Aldrich get a little bit of a bump there from the stock price that was, they got a bit of an ump on the stock price on the day of the acquisition by Merck GmbH, the German Merck, was announced. Got a little bit of a premium there. So the projected annual return suffers as a result. So on the next slide, why I've selected BP, there are a couple of reasons. I mean, energy is critical in the world and the way it's constructed, and really it's a stroke of genius to extract liquid or gaseous hydrocarbons from the ground and burn them in the air. But our entire economy is built around oil, and we've seen recent historical events where blood and treasure were placed in the defense of oil that illustrates the importance to the economy. Even in the chemical industry where I work, 90% of chemicals are derived from oil and gas in some fashion. It's critically important. BP has suffered a self-inflicted wound. We'll talk about the Macondo spill later, but they've also suffered recently from an acquisition in Russia. Because of the turmoil in Ukraine and the sanctions imposed against Russia, companies with a significant amount of their assets in Russia aren't doing well. And my contention would be that, as nutty as sometimes Putin seems to be, this is going to be a short-term effect. Short-term could be a number of years, but ultimately these things don't last forever. And for a long-term investor, you can take advantage of Temporary insanity, temporary of course could be measured in years as a caution, to bolster your portfolio. So if we move on, I think I'm going to skip this slide and move on to the next slide. And the next 5 or 6 slides come from a report published by BP on the website. It's actually a text of a presentation that was given less than a month ago. And I have sent that to Mark, who I think will upload it to the Manifest Investing website. On this slide, the key thing is the fact that energy demand, and the relative measure here are billions of tons of energy, will increase steadily and have increased from 1990 and will increase from today through 2035. Now the annual rate of increase isn't dramatic. I mean, the total increase from today is probably going to be about 40%, which means about 1.5% a year. It'll be dominated by gas. Gas will grow at almost 2% a year. This is the projections of the economists at BP, and it's taken from a number of different sources and validated by external independent sources as well. Oil, on the other hand, is going to grow by less than 1%, about 0.8% a year. So the growth itself is paltry, most of it happening in non-OECD countries. So these are it's the Organization of Economically Developed Countries. And most of the growth will happen in emerging economies, which is fine and not unexpected. And you can see on the far right where oil will increase slowly, gas will increase more dramatically. The use of coal is projected to increase as well. Interestingly, if you go near the middle of that list and reach coal, at least the combustion of coal, has the largest impact on the environment overall. Even though a lot of technology has been devoted to cleaning coal and cleaning the gases produced by coal, it still is a pretty messy for the atmosphere. If we move on to the next slide, slide 29, this is just their perspective over a history on where oil has been coming from, and it's really the aggregation of some of the competitors, Total being a French company that's big in this area. North America just has been more dominant than many people would expect. A lot of that is obviously US and Canada. Europe, there's a surprising amount of production of oil in Europe, and that has increased dramatically. That is Norway and Scotland, primarily. And you can see in Africa as well, mainly Nigeria, oil has been gushing from that part of the world for some time. And of course, for me the interesting thing is the Americas, other Americas, because the fact of the matter is that Venezuela has the largest provable oil reserves on the planet. Yet because of the way it structures its government, or the government structures the country, it really doesn't seem to be able to take advantage of that. But I think 40% of the proven oil reserves on the planet would be under the control, directly or indirectly, of Venezuela. So we would imagine that the Southern American hemisphere will dominate as we move forward, larger even than Saudi Arabia. Now on slide 30, BP talks about its inflection point, and it recognizes that it goofed up in 2010, and it's done a lot of things to correct that. The key thing that it's done is, and I'll not move to the next slide yet, but it is handling as best it can the legal problems that it has because of the oil spill in the Gulf in 2010. It's also changed the company orientation to focus primarily on safety, and it is investing in and buying assets in Russia, which turns out that it's moved from one risky proposition to another, at least in the short term. And on the next slide, the company is talking about its 10-point plan. It doesn't cover all of them here, but the key things is a focus on safety right across the board, from drilling to the transportation of oil, selling off non-productive assets, and then focusing on shareholder growth through increasing the dividend, which took a whack in 2010, and share buyback programs as well. And then we'll skip quickly to the next slide, where it talks about its legal proceedings, and it has made a large effort to what it calls compartmentalize these proceedings. It complains in its annual reports, and it has for a while, that it's making a lot of payouts in the Gulf to illegitimate claims. But the fact is, when you dig into it, you can see that BP promised to do things. It was a little bit rash in some of its promises. So a lot of people who were not directly impacted by the spill have made legal claims against the company and have got funding as a result. BP claims that it's in a good position in the sense that it will be able to pay off all its claims and all its future legal costs, which could amount to about 50 billion. The company has about 24 billion in revenue per year and about 20 billion in cash flow. So it's paid off a lot of these already. There are some still outstanding. It doesn't seem worried that it will impact the company too detrimentally in the next few years. And then on the next slide, I don't want to hog too much time, but it talks about how it has refocused itself. It's got rid of 50% of its installations, 35% of its wells, about half of its pipelines. And you can see that kind of light greenish yellow that the dots are on. That is the new field in Russia, the new investment that it made. It took a 19.75% stake in Rosneft, which is in the Russian Republic. A little bit risky right now, as we said, but in the longer term, I think it may turn out to be a good investment. And there are more details of that in the talk to which I referred earlier, and that'll be uploaded to the Manifest site. So I think if we move on, it might be the last one. Well, it's talking again what I talked about, getting rid of installations, wells and pipelines, trying to focus on higher value items. So it has had quite a few divestitures. And here we're looking at playing to its strengths. You can see on the bottom left where it looks at its key investment by regions. Most of them are in relatively politically stable parts of the world, perhaps with the exception of the Middle East. On the top left, it looks like its exploration effort, most of that happening in the Arctic. It talks about its unique position in Russia with its new partnership. And on the bottom right, you can see where its downstream businesses are located, for the most part in relatively stable parts of the planet. And I think if we move on, again, this is just about Russia and the dominant position it now plays in that country, thanks to its recent partnership. And this looks at millions of barrels of energy per day. So it really dominates in terms of production in 2013, but in terms of the bottom line, the offshore resources, you can see ExxonMobil is in a slightly better position. The last line is billions. And in summary, it talks about what it's going to do for the future. It's going to provide value over volume. It wants sustainable free cash flow. Its operational cash flow is 20 billion a year. It's pretty impressive. And it wants growing distributions to its stakeholders, primarily shareholders, through an increase in its dividend, and that has happened. The dividend hasn't fully recovered, but is well on the way to being completely recovered from the 2010 disaster. Its dividend yield at the moment is 5.3%. So here we see a stock selection guide, a little bit flat in terms of sales, and we can clearly see what happened in 2010. And its earnings are suffering at the moment, as well as its pre-tax profit. That's got to do with the geopolitical environment, the hope being that this will improve over time. The next slide looks at part 2 of the stock selection guide. Again, you can see what happened in 2010, and the return on equity is going to suffer from all of the divestiture activity that is ongoing. But it has a relatively good return on equity, a little bit lower than it has been in the past, and the 5-year average pre-tax profit on sales softened compared to pre-recession, but is going in the right direction. And then if we move along to the next one, we can see something about the price-earnings ratio, a bit of a disaster again in 2010, but typical for energy producers, not a .com here, but in the 6 to 10 range for PE ratio. And then if you look at the part 4 of the stock selection guide, because this is really a dividend play in most instances, the low that I chose was the price the dividend would support, which inevitably, in many cases, pushes things either into the sell zone, in fact, or more likely into the hold zone. And this company really belongs in the hold zone. It's not in the buy zone now, according to the stock selection guide. But I was very conservative, I think, in terms of the low price that I chose. But I tend to do that for companies that have a high dividend yield, because I know darn well that pension funds and related entities tend to pay a lot of interest to these types of companies and tend to kind of support it when the dividend yield looks rosy. So if we move on to the next, where we're looking at manifest investing, here we have a projected annual return of 12% plus 12.3, quite impressive compared to the rest of the field. And the quality rating is, I would say, it's not super, but that's not surprising given where the company is today. And by the way, it hit a low of $27 per share in the middle of that gushing oil incident in 2010. So it's not quite close to that yet, but it's getting there. And you can see the projected annual return has been growing in the last few months as the price has sagged. And if we look at the Fool's rating as well, and I told you I'm a jaundiced view of this, but still the All-Stars seem to give it a thumbs up, 94%. So in summary, BP is a changing company. It really got whacked a number of years ago, and it showed there were a lot of flaws in its management, but it seems to be addressing those. It did buy something or invest heavily in Russia, and that's hurting. It's a drag at the moment, and the stock price reflects that, but I would imagine for the long term, BP in particular and energy in general is not a bad buy. I would predict as the oil price per barrel of oil decreases, and it should continue to decrease over the next few weeks and months rather, and I can at a later date tell you why I think that would happen. Companies like ConocoPhillips and Shell and BP would be very good buys. Energy usage is increasing. The growth of the population and the distribution of free market economies, or as that takes hold in emerging economies. So I think BP for the long term is a good position. I do think the stock price will get lower, at least I hope it will, but we will see. But for now, I'm going to add BP to the portfolio.
Thank you, Hugh. Hugh, we have one question from Linda, and she says, what about OPEC's decision to keep production up? How will this affect companies like BP?
Well, in the short term, it's going to lower oil prices. I mean, the interesting thing about the oil industry is that production is very inelastic. I mean, a very, very small change in demand, and that can happen as some economies slow down, can have a major impact on the price per barrel of oil, because these companies have very high fixed costs and they tend to be very price competitive. So what I think you're going to see is even lower price per barrel of oil, which means I'm going to buy more BP and I'm going to buy more ConocoPhillips and Phillips 66, which I've been buying on and off for a while. So I'm looking forward to that happening. But the other side is that when demand increases very, very slightly, it has a major impact on the price of a barrel of oil. So that's why you see kind of nonsense in that industry, where in the last 5 years we've seen oil go to under $30 per barrel, and we've seen it jump wildly in excess of 150. And there's no reason to expect that that won't continue for the long haul. Long answer to a short question.
Thank you, Hugh.
It'll impact the price, but not the company.
Thank you. Let's move on now to the last stock that we're going to present, and I'm doing two persons jobs here today, so if you give me just a moment to get on to the well, if I can find it. There it is. Okay. And I'm going to be presenting a company that's new to me. It's called ITC Holdings. And I'm going to talk just a little bit to start with about where the idea came from. I do a lot of traveling in mid-Michigan, visiting clubs, and twice in the last 6 weeks I've gone to Mount Pleasant, Michigan, which is the city where Central Michigan University is located. It's about an hour and 10 minutes from my home, and I have to drive through a lot of very flat farmland to reach Mount Pleasant and Central Michigan University, where these clubs happen to be located. And I discovered in my drivings about 6 weeks ago that the area that I'm driving through is just loaded with wind farms. Well, when I went the second time, my wife went with me, and we began to discuss how exactly did that power from all of these wind turbines, and you go mile after mile after mile with just hundreds and hundreds and hundreds of these wind turbines operating, making power. And so we said there must be some way that they're transmitting this power from these turbines onto the grid. So that was the kernel of an idea to look for a company that dealt with this type of transmission. Well, my research led me to a brand new federal agency. I had never heard of FERC before, F-E-R-C, but that's the Federal Energy Regulatory Commission, and it turns out that this commission is charged with, number one, increasing the reliability and the size of the electric grid throughout the entire country. Number two, with setting rates for people that transmit power from places like these wind turbine farms to the people that generate the power or that provide the power to your home. And in addition, FERC has a big interest in seeing that all of this is done in a very reliable way, a very safe way, and a very progressive way. Well, that FERC reference led me to this company, ITC Holdings. Back in 2003, ITC Holdings was known as Detroit Edison. And you can see on the left of this slide that the area that it covered was the Detroit metropolitan area. That's the area at the bottom of the blue. Up into the Port Huron area, that's the area in the middle on the right, and then up into what we Michiganders call the Thumb area, a very flat agricultural area of the state. Well, that was 2003. Today, when you look at the map of ITC Holdings, you see that ITC covers most of the state of Michigan. That's the dark blue. They also have a large presence in the state of Iowa, and it kind of floats into some of the surrounding states around Iowa. And then all of the lines are transmission lines that ITC owns directly. So they have a large project in a transmission line, a major transmission line between Nebraska and Kansas, and another one in southern Nebraska, one in southern Oklahoma, and a number of transmission lines going from Iowa into neighboring states. This is the only pure play public company on the transmission end of electrical power. So they transmit power, and that's all they do. They do not generate power. They do not distribute the power to customers. They just transmit it from point to point and facilitate the movement from places where electricity can easily be generated to places where electricity is really needed. So think rural to large city. You can notice the increase in assets in the last approximately 10 plus years, from less than $1 billion to $6.3 billion, from one state to 7 states, from 170 stations and substations to more than 540. And the most telling number is this 2,700 miles of transmission lines to over 15,000 miles of transmission lines today. ITC basically is looking to grow its business, and they've put aside $4.5 billion, that's with a B, billion dollars of capital money for investments through 2018, and they're going to use that money to drive superior growth. In other words, they're going to be out there building more transmission lines, more miles of transmission. They expect their compounded annual growth rate for earnings per share to be somewhere in the 11 to 13% range, and they feel that there's potential upside as they look at different M&A activity, different mergers and acquisition activity. $3.3 billion of aggregate cash flow. Kim was talking about loving cash flow. Well, here's an awful lot of it going to be generated from 2014 to 2018, and all the while carrying a really solid investment-grade balance sheet. They're growing their dividend at 10 to 15% annually. That's based on about a 30% payout ratio, and about $250 million of share repurchases have been authorized through 2015, with an additional $750 million authorized through 2018. I've taken a paragraph from the Morningstar analyst report because I really believe that economic moats contribute to the stability of a company's earnings. And Morningstar thinks that this company has about as wide a moat as it possibly can have. That means that the incentives for competitors to come in and build something similar to compete are very low. Notice the one underlined sentence, there's little incentive to build competing transmission lines if one that ITC already owns and is serving a market's full capacity. And that's based on this idea that this regulatory commission approves new transmission lines only if there's a demonstrated need for new capacity. Here's some comments from the Value Line analyst report. They are raising a red flag. ITC and other transmission owners are facing a complaint about their return on equity being too high. Right now, FERC sets the return on equity for these transmission companies, and it sets it based on a premium to what it takes normal utility companies to transmit power. In other words, FERC is trying to encourage the creation of more transmission lines and encourage the creation of transmission lines from where power is being generated to where power is being used. To do that, they give the companies that are doing this a little bit of a premium, but recently that premium's been coming under a little bit of question. Value Line does not think, and neither does Morningstar, that this premium is going to be significantly reduced in the near future, but they want it brought to everybody's attention that the problem does potentially exist. Value Line sees low potential growth going forward at about 7%, high at about 17%. You can see the robust growth rates, 12% in revenues, 15+ in earnings. That's based on a stock price somewhere between $37 and $39. Morningstar says $37 is a fair value for the company. And now I'm looking at a traditional SSG. I'm looking at the kind of lines that we all like to see in companies that we invest in. They're reasonably up, they're reasonably straight, and they're reasonably parallel, especially since the recession of 2008. You notice in Section 2 we have pre-tax profit margins that are generally trending upward. We have a good, solid return on equity, and again, it's trending upward as well. And because the company does a lot of capital expenditures and a lot of M&A activity, we are seeing a fair amount of debt. This debt number, by the way, is not uncommon in many of the companies that deal in the utility industry. Moving to Section 5 of the SSG, I'm showing a projected average return going forward of about 12%. And if I look at the manifest page, I see that about 12% is the par that Mark has assigned as well, based on the consensus numbers from a whole host of analysts. The quality for the company is at about as high as you can get. It's in the 99th percentile, and you can see that the 4 quality pillars, which are down at the bottom of the page down here, I'm moving my cursor by them right now, you can see that they all contribute fairly equally to the total quality for the company. The company doesn't have a weak pillar among the 4 that we measure. Here I'm looking at the graphs for ITC, and I notice the quality line, that's the blue line at the top, has stayed relatively consistent at a very high rate. I'm looking at the red, and the red has moved back up to perhaps here if I were to look at a October reading or a November reading for the company. So I like to buy a company when it's giving me a par value somewhere near the historical high. Of course, this might be the ideal place to have bought it, but when the par is sitting at the point of my cursor right about here, I think I'm getting a pretty decent par going forward as well. So I present to you ITC Holding Company, and it's a pure play on electrical transmission. I'm going to move now to a poll. Let me see if we have any questions here. Nick, my forecasted earnings growth rate, I'm not going to show at the moment. I find that people take my numbers and assign them as correct. So I will leave it to you to decide what you think is an appropriate growth rate for earnings and for sales, as well as high and low PEs. I do come up with a par value of about 12%, so that is very much in line with manifest, and if you come up with a number that's in the same ballpark, then you're using numbers very similar to mine. Let's move to our polls right now, and I'm going to launch the poll, and we're going to ask you as audience members to choose one of the 4 companies that we presented today or none of the above to add to our portfolio. So the polls are now open, and you just have to use your cursor to hit one of them to vote. I'm going to leave the polls open until we get somewhere in the 80 or 90% voting range here. We're up to 75% of people that have voted. If you haven't voted, it's easy. Just click on the on your choice, and we'll see where we're headed. We'll hold the polls open for about 10 more seconds. We've moved up to 85% voting, 87% voting. We can watch it move. There's 89% voting. And I'm going to close the poll, and I'm going to share the results. And sharing the results, let me see if I'm getting to the right place here. Again, I apologize for being just a little bit preoccupied, but I'm trying to do a couple of different things here all at once. Well, I hope you're seeing the results that I'm sharing. Let me tell you that 48% of you have decided to add ITC Holdings, 27% of you voted for TROW Price, 13% for Liberty Media, and 11% for BP. 1% of those voting didn't want to add any of those 4 stocks to the portfolio at all. So let me get back now, if I can, to where we were. I'm going to hide that slide and get back to where we were at the end of this session and see if Mark has any other slides he would like to share with us. Well, you know, if you go the right way or towards the end, you get there faster. And it looks like there are no other slides that we're going to be sharing here. Other than to announce that the December roundtable will be held on the 30th of December. At 8:30, we're going to go back to a week evening so we can attract most of our audience again. And we will be running a Manifest annual conference. We don't have a date or a time or a place right yet, but you might want to save the dates if you're in the mid-Michigan area or the southeastern Michigan area. We're planning to try to do something right around Groundhog hog weekend somewhere between the 30th of January and the 1st of February. I want to thank you all for coming. I especially want to thank Hugh for getting out of bed so early this morning, and I want to thank Kim. Kim, we always appreciate your input and your stock selections. Thank you so much for helping out. I will keep the lines open after an official close right here to answer any questions that exist, but I want to wish everybody a happy Thanksgiving, and this marks the end of the official roundtable session.